US yields have been surging now, in fact, around the 430 mark. What's propelling this and what's the impact of it on the Indian bond markets? That's what we'll be discussing today. And for that, I have with me Abhishek Bisen, the head of fixed income with Kotak Mahindra Asset Management Company Limited. Hi, Abhishek. Thank you for speaking with us. Let's start off by talking about what happened in the United States, or rather what is happening currently. The constant surge in the US yields, now trading at close to around that 430 mark. What are the factors that are propelling this?
So what is happening in the market, especially in the US economy, the last mile of inflation is proving to be a bit sticky and difficult. And given the track record which the central bank had over last year, things have been broadly surprising on the upside, and they've got caught slightly off guard. So they want to see things settling down first before acting on the rates. This data surprising is causing some amount of volatility. Things are a bit more unpredictable. So if you observe the volatility subside down significantly over a period of time, it has been heavily volatile, almost 100 basis point in weeks. Now it has come down 50 and 30. So it is from 4 to 430 it has happened. And incrementally, if you look at, even if the data surprises on the upside, yields are not moving, which means it is broadly in the prices at this point in time as we speak.
Now, usually when we see this kind of a surge in US yields, there is that reaction in the EM yields too. But interestingly, there is a nice bit of stability that we are seeing in Indian yields. There's not been much volatility. What is the reason behind that?
So Indian yields are actually reflecting our own fundamentals by and large. It is getting driven incrementally. They've been demonstrating for a fair amount of time. Therefore, if you observe the differential between the US 10-year and the Indian 10-year has, from a peak of almost 550 basis point odd, has been sub 300 mark at this point in time. So that has been demonstrating that our own fundamentals are warranting much lower yields vis-a-vis the US, where the rates, real rates were negative and Indian real rates were positive. So incrementally, that's what is driving. And over and above that, the index inclusion has changed the game. And over and above that, the fiscal profile, which was laid out by the budget, is acting on the yields. Therefore, any negative news, the uptick is very, very limited. And if there is something positive, the yields decelerate very, very fast.
Let's talk a bit more about that index inclusion. It's one of the reasons why we have seen a nice amount of inflow coming into Indian bonds. For the last 4 to 5 months, consistently, we've seen foreign investors pump in money into Indian bonds. Considering these factors that you mentioned, the strong fundamentals, do you see these kind of inflows continuing?
Yes, of course, because if you look at overall in the emerging market space, India bond yields are really attractive. And given the overall demand which is expected to be generating because of the index inclusion, especially in the JP Morgan and one of the Bloomberg indices, hardly anything has been bought at this point in time. So this flow is going to get trickled down, and as and when actual demand comes in, from the index guys who are the actual consumers, it is going to gain pace. So things, a good amount of story is yet to unfold, and the impact is yet to be seen.
So what would be your outlook on Indian yields from here on? What are the factors that you would like to monitor?
See, one of the trick here is at the end of the day, it is the GDP which should drive things, right? And the GDP numbers have been sort of encouraging. The economy is doing very well. If you look at the equities, they are showing you the true picture. So, which is what is driving the driving force at this point in time. And unless and until there is some big amount of deceleration, nothing is going to happen in a haste. And which is what is causing this sort of sideways movement in the yields at this point in time. So if you observe, after 6.5, RBI didn't hike rates, but the overnight rates went up almost close to 7%. So which was driven by liquidity. And in order to support growth, you need liquidity in the system, which will gradually ease up probably starting next year. So that is going to be the first move, and which will effectively pull down yields further as we start the next financial year. So this is what we are looking at. One is liquidity, other is the GDP numbers one should watch for.
So the outlook for the Indian bond market does seem very positive. To sum up our conversation then, what's the strategy, the advice you would give fixed income investors in India?
See, we are in a fundamental shift. That's what we've been highlighting. And these fundamental shifts are going to have some amount of structural benefits over a long period of time. Therefore, we are recommending investors to increase duration of the fixed income portfolio and try and lock these yields for as much as long as they can, because the moment these structural benefits start unfolding, the levels or the spreads are going to shrink, and which will mean that incrementally whatever flows you are going to get from your own investments or cash flows, etc., are going to get redeployed at a lower and lower levels. So the prudent strategy would be to just lock in whatever you have at this point in time from fixed income allocation at the longest point. So in order to get the maximum benefit out of the entire move, which is going to get unfolded from 12 to 18 months time frame.
The Indian bond market is undergoing a structural shift owed in part to the strong economic fundamentals. Hence, Abhishek advises increasing the duration of your portfolio. That was this month's debt market outlook. Stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.